All right, let's jump right in. Welcome back to today's explainer. Look, we're tackling a milestone today that practically everyone faces. But honestly, surprisingly few people get right. We're talking about investing your very first $100. Now, we all want to be smart with our cash, right? But what if I told you the biggest hurdle to growing that first $100 isn't, a lack of financial genius? It's actually our own worst impulses. Seriously. Today, we're breaking down the exact systems you need to protect your money from, well, your own self-sabotage. So picture this. It's just a random Tuesday. You pull up your bank app and you see you've got exactly $100 extra sitting there. You don't need it for rent, groceries are covered, phone bills paid. You stare at the screen and think, okay, this is it, my investing era. It's super exciting. I mean, it really is. But man, it is also incredibly overwhelming. You're completely ready to start building wealth, but suddenly it feels like there are a million different directions pulling at you. And what's the very next thing you do? You open up social media. And wow, notice the massive disconnect here between what we see online and what actually happens in the real world. On one side, you've got this wild expectation, right? Influencers literally screaming at you to turn that $100 into 10 grand in 30 days. They're pushing the next hype crypto coin or some obscure penny stock they swear is the next Amazon. But the reality is so much darker. $100 is totally enough to start, but tragically, it's the exact amount people blow while chasing these ridiculous shortcuts. And here's the worst part. When a beginner loses that first 100, they don't just lose the cash, they lose their confidence. The momentum is gone, and more often than not, they just throw in the towel and quit entirely. So this brings us to absolutely crucial point number one. The real obstacle isn't a lack of intelligence, it's your behavior. We're going to harp on this a lot today because it is without a doubt the number one trap for beginners. Investing your first $100 isn't about picking some magical needle-in-the-haystack winning stock. It's about building a solid system and turning yourself into someone who invests calmly and automatically. Because the thing that absolutely destroys beginners, human emotions. We're talking fear, excitement, ego, and just pure impatience. Don't believe me? Just look at what our own emotional baggage is actually costing us. Look at this 2024 Dalbar research. It shows the average equity investor returned about 16.5%. While the S&P 500 returned over 25%. I mean, that is a massive, massive gap. And that gap, it doesn't exist because regular investors are somehow stupid. It exists because human emotion drives us to buy and sell at the absolute worst possible moments. People try to time the market based on pure fear or greed, and they totally miss out on the actual growth. Let's break down exactly why our brains are just actively working against our financial best interest here. First off, your brain literally craves excitement. Day trading a highly volatile stack, that feels thrilling. But putting money into a broad index fund, kinda boring, right? Second, your brain absolutely hates being wrong. So when an investment drops even a little, fear takes over, and people panic sell just to make the pain stop. And third, our brains really want the illusion of control. Picking a single stock makes you feel like you're in the driver's seat, whereas buying the whole market just feels too passive. But these emotions are exactly what keep beginners from ever reaching their goals. So, now that we know our own brain is basically the enemy here, let's map out our game plan. Today we're hitting 1. The first 100 trap. 2. Your brain is sabotaging you. 3. The 3-bucket framework. 4. Automation beats motivation. And finally, 5. Avoid the silent wealth killer. Let's get into it. Step 0, the emergency check. Before you even think about looking at a stock chart, we have to talk about the absolute first thing you must do. You have to ask yourself, if an unexpected expense pops up tomorrow, are you going to need this money back immediately? Because if the answer is yes, then investing should absolutely not be your first move. Check out this crazy stat from the Federal Reserve. Only about 63% of adults could cover a $400 emergency expense using cash or savings. Even wilder, 18% of people said the largest surprise bill they could comfortably handle was under $100. Guys, if a flat tire forces you to liquidate your brand new investment, that investment didn't help you build wealth, it actually hurt you. And that leads perfectly into the super powerful psychological concept known as loss aversion. Basically, this is the hardwired effect where we feel the pain of losing money way, way more intensely than we feel the joy of gaining it. So when a stressful emergency hits, your brain doesn't just sit back calmly, sipping tea and analyzing long-term market returns. No way. It screams, we need cash right now. And boom, that triggers a panic sell at the absolute worst possible time. Having even a tiny cash buffer, that is what prevents this whole emotional short circuit from happening in the first place. Which brings us to the 3-bucket framework. Let's look at how we actually build a logical system to fight off those impulses. Just think of your $100 as having 3 possible destinations. Bucket 1 is safety. If your emergency savings is sitting at a solid zero, putting that $100 straight into a basic savings account is absolutely your best move. You are literally investing in your ability to stay invested later. Okay, bucket 2 is high interest debt. Got a credit card charging you, say, 25% interest? Paying that down is effectively a guaranteed 25% return on your money. Let me tell you, the stock market is never going to guarantee you 25%. So plug that hole first. Then, and only then, once you've got a small buffer and zero urgent high interest debt, do you finally move to bucket 3, actual investing. All right, so let's assume you are officially ready for bucket 3. I'm just going to be totally blunt with you here. Your first $100 should absolutely not go into individual stocks or the newest meme coin. Could you get lucky? I mean, sure, maybe. But chasing meme coins and penny stocks, that is straight up lottery behavior. It's driven 100% by ego and the craving for excitement. Smart investing means buying the entire market at a super low cost using broad market index funds. Really think about this for a second. If professional full-time fund managers, people with huge teams and supercomputers, struggle to beat the market over the long haul, and the vast majority of them do, a beginner is definitely not going to consistently outsmart the market with a $100 trade. Next up, execution, filling bucket 3. Here is the exact step-by-step blueprint for taking action. Honestly, it boils down to 4 super simple steps. Step 1, choose the account. You always want to aim for the lowest fee and most tax-efficient account you can find. Think employer match programs or tax-advantaged retirement accounts before you ever touch a regular taxable brokerage. Step 2, choose one fund. Do not overcomplicate this part. Pick a wildly diversified index fund like a total market or an S&P 500 fund, or just grab a target date fund that literally does all the adjusting for you. Step 3, invest the $100. And hey, don't sweat it if a single share costs more than $100. So many brokerages allow you to buy fractional shares now, which means you can just buy a tiny slice of the entire global market immediately. And finally, step 4, automate your next contribution. And that leads us to this rule: automation beats motivation. That 4th step is just so ridiculously important. Let me show you why. If you invest your $100 exactly once, and you never add another dime to it, assuming a standard historical 7% real return after inflation, in 30 years that $100 grows to about $760, which is, it's nice, but it's not exactly life-changing. But look at this. Look at the massive difference if you just bypass your ego entirely and build a quiet, automated habit of investing just $25 a week for 30 years at that exact same return. You end up with roughly $120,000. And guess what? You didn't do this by being some Wall Street stock-picking genius. You did it by just being consistently, beautifully, boringly automatic. Section 5, avoid the silent wealth killer. Because yes, there is a catch. There's one sneaky detail we need to cover. I am talking about fees. And look, I know fees are incredibly boring to talk about, but honestly, that is exactly how they get away with secretly robbing you. Some actively managed funds will charge you around 1% per year, while a ton of broad index funds charge something tiny like 0.05%. Now, a fraction of a percent might look like literally nothing today, but stretch that out over decades, that tiny difference compounds massively. In basic models, a low-fee fund can easily end up over 30% larger than a high-fee fund over long stretches of time. Think about that. That is thousands and thousands of dollars of your hard-earned wealth just vaporized, lost to fees, simply because you didn't check a box for the low-cost option. Finally, rewiring your behavior. Let's bring this all back home to that core psychological trap we started with. Because at the end of the day, investing isn't a math problem. It's a behavior problem. We just have to accept this totally counterintuitive truth. Ironically, doing less is almost always the winning strategy. I know our brains desperately want the thrill. Our egos want the total control of day trading and sniffing out the perfect time to buy the dip. But the cold, hard data from everything we've looked at shows that true generational wealth is built on boring, hands-off consistency. The people who actually win at this game don't rely on perfect timing. They build better systems. They keep it boring. So, I want to leave you with a direct challenge today. I call it the 24-hour challenge. What are you going to do with your very next $100? Seriously, don't just finish this explainer, close the tab, and move on. Take one concrete action in the next 24 hours. Put that $100 into an emergency savings buffer to protect yourself against loss aversion. Or log in and use it to knock out a chunk of that high-interest credit card debt. Or, if you're ready, invest it into a broad index fund and set up a $10 a week automated habit. Just pick one and do it. Because if you can conquer your own emotions and actually set up a system that just hums along quietly in the background, one day you're going to look up and realize something pretty incredible. As the source material puts it so perfectly, the money isn't the biggest thing that changed, you are. You will have completely transformed yourself from someone who gambles based on anxiety and fear into someone who manages wealth calmly, confidently, and automatically. So when you look at your next $100 sitting in that account, ask yourself, what kind of investor are you going to choose to be? Thanks so much for joining me on today's Explainer, guys. I'll see you next time.